Inside a $250 million London mansion, how billionaires buy real estate. Welcome back, and in this video we'll deep dive into one of the most jaw-dropping real estate deals in recent UK history. Picture this, a 40-bedroom Georgian mansion, The Home, nestled within the heart of London's prestigious Regents Park, initially listed at an astonishing £250 million. But here's the twist. It was recently sold for 138.9 million. Yes, that's a mind-blowing 111 million price drop. And the buyer? Wrapped in mystery. Some people are suggesting it's an American tech billionaire that has claimed this piece of history. But if I was in the market for this property, how would I finance it? And perhaps more interestingly, why do the ultra-wealthy often choose to finance their luxury acquisition instead of paying cash? I'm often asked that question. Why do uber wealthy people borrow instead of using their cash? When you look behind the curtain on the sophisticated financial strategies of the world's elite, high net worth individuals leverage their wealth for maximum financial advantage. The principles of strategic borrowing, and why even billionaires opt to take out loans. Let's have a closer look. Before we dive into the art of strategic financing, let's take a moment to fully appreciate The Home. The Home is spelled H-O-L-M-E, if you're wondering. This isn't just any mansion, it's a landmark of British architectural excellence. Built in 1818 by the legendary property developer James Burton, The Home stands as a testament to the grandeur of Georgian architecture, spanning an awe-inspiring 29,000 square feet. This estate is more than just a home, it's a statement. And here is what makes it truly remarkable. It has 40 bedrooms, enough to house not just a family, but an entire entourage. A grand dining room. Imagine hosting extravagant dinners in a space fit for royalty. A private library stocked with rare and classic literature embodying old world charm. A tennis court. An underground swimming pool. No mention of any saunas or cold plunges yet, but anyway, it's luxury at its finest, providing leisure and fitness in absolute privacy. It has an unparalleled location situated in the exclusive Regents Park area, surrounded by lush greenery, yet moments away from London's bustling city centre. This is not just real estate, it's history. Prestige, power embodied in bricks and mortar. Now, let's address the elephant in the room. Why don't billionaires just pay cash for properties like this? It's a common misconception that the ultra wealthy simply sign a check and call it a day. In reality, the financial strategies at play are far more sophisticated. The key motivations behind financing include many factors. Liquidity management, keeping cash reserves available for high-yield investment opportunities. Leverage, when you use borrowed money to generate higher returns elsewhere. Tax optimization, benefiting from interest deductions and strategic wealth preservation, especially with inheritance tax at the time of purchase in the United Kingdom. Diversification, spreading financial exposure across multiple assets rather tying up capital in just one. Before you embark on such a colossal purchase, it's super crucial to get behind the detail of the client's balance sheet. A thorough financial assessment is crucial. This involves three fundamental pillars. Point 1. Income. For a property of this magnitude, demonstrating a substantial and stable income is essential. Lenders want assurance that mortgage repayments are sustainable. Typically, an annual income in the range of 20 to 30 million would be a benchmark, ensuring that debt obligations are met without disrupting other financial commitments. Point number 2, assets. Beyond income, the nature and liquidity of assets matter greatly. This includes cash reserves, investment portfolios, business holdings, existing real estate, crypto. Lenders will favor borrowers with liquid assets that can be quickly accessed if needed. A diversified asset base not only strengthens borrowing power, but also signals financial resilience. Number 3, liabilities. And if you're like me, children are a big liability. They burn more cash than you can imagine. And for me, especially with 2 daughters, that's just an ever-growing daily challenge. Anyway, let's get back to liability. Even billionaires have liabilities: business loans, investment leverage, personal guarantees, philanthropic commitments. What matters is how these liabilities are structured. Balanced debt to asset ratio is crucial to ensuring financial flexibility without overexposure to risk. So why borrow when you can pay outright? Let's break that down. Liquidity preservation. Holding onto liquid cash allows for quick pivots into new investment opportunities that could generate higher returns. With leverage and arbitrage, borrowing at a low interest rate can be as low as 3.25% when looking at single stock lending options. This will also allow that cash to be then invested in high return opportunities, which can be between 8 to 10%, and this results in positive leverage. So you borrow one side of the balance sheet at circa 3.5 if it's a single stock, and you invest in the other, getting the yield at 10. Keep your cash, and that's why it's super important and why many billionaires and wealthy people borrow money when buying assets. Tax planning and tax efficiency. Mortgage interest can be tax deductible in some jurisdictions, reducing your taxable income. Inheritance tax when buying in the UK is an important consideration. Diversification, keeping capital free for investment in multiple asset classes rather than buying and sinking all of the cash into one single property purchase. Now, if I were to advise you on how to finance this property, this is how I would do it. I would study your balance sheet. I would look at your existing private bank relationship, those that specialize in financial transactions and have the balance sheet to accept such a significant loan on a unique property. The tailored solution would look at what assets you have, what liquidity those underlying assets hold, the loan to values that are possible. The interest rates relating to each asset class will determine how I would structure this deal. If you were looking for blended finance, and what I mean by that is you may have a single stock or a portfolio of investments plus the real estate, you would look at what loan to value can be achieved on each asset class. The mortgage or the private facility would most likely be interest only. This would give you lower initial monthly payments for greater cash flow. Currency hedging, if the rumors are to be true and it was a US national buying a sterling asset, then protection against fluctuations with international borrowing costs would be important. So when studying your balance sheet, it'd be really interesting to see what other assets you own. If it's a single stock, Google, Apple, Vodafone, etc., or even Bitcoin, you can borrow from pay rates as low as 3.25% for terms ranging from 18 months to 5 years. And that is correct. That's a pay rate of 3.25%. So if you did have those types of investments, we could look to leverage that asset class to release liquidity to contribute towards the mortgage. Single stock lending is the most cost-effective way to borrow right now anywhere in the world. If you didn't have single stocks, we'd look at portfolio investments. What do you hold? And whether Lombard lending stroke margin lending, which is where you borrow against that portfolio of investment at a margin from 50 basis points over your cost of funds, depending on which currency you are borrowing in. Then you would look at the real estate itself. This mansion, 138.9 million to be precise. What loan to value would a lender lend on that asset? Generally speaking, the majority of private banks, if they were to lend, would be in a probably 25 to 50% loan to value max. But that will be determined by the overall balance sheet you have. If you combine the other assets that you hold, the single stocks, the portfolios, and the mortgage, you can then get a blended facility. So you'll have a rate for the mortgage on the property, you'll have a rate for the facility on your Lombard portfolio of assets, and then you'll have a rate for the single stock lending. And a combination of all three, if structured correctly, could achieve 100% loan to value on a purchase of 138.9 million. This is all dependent upon your balance sheet, and everything would be negotiable. Fees, rates, margins. But as always, seek professional advice. This is something that we do on a regular basis. And this home isn't just a mansion, it's an asset class on its own. And while owning such a property may seem like the ultimate flex, the true power lies in how you acquire it and how you finance it and how you hold it as an investment for the longer term. The ultra wealthy don't just spend money, they strategically deploy it. Mastering the principles of financial leverage, tax efficiency, and liquidity preservation, they turn luxury purchases into smart investments. I hope you liked this brief introduction into the world of ultra high net worth individuals and how they finance luxury assets, and in this case, it's a mansion. Please don't forget to like and subscribe and drop a comment below. What would you do if you had 138.9 million to spend? Let's discuss. As always, thank you for watching. Until next time, stay smart, stay strategic, and keep building your wealth. Thank you for watching.